Depending on where you are in your career, don't panic if you don't have money saved up or if you haven't started saving towards retirement. Over half of US households don't have any retirement savings, but what you can do is start thinking about it now so that you can somehow get ahead. My name is Laila Maidan, and I'm going to tell you 6 ways of how you can level up your investing. Diversification. You want to have a diversified portfolio. This way, not all of the assets that you're invested in are going to move in the same direction, especially when that direction is downwards. What does diversification look like? Well, it could look like having a portfolio that's 60% stocks and let's say 40% bonds, or it could look like having some real estate or having some commodities or having some exposure to foreign stocks as well. And so as the economy changes, let's say we have high inflation or interest rates rise, certain asset classes will either go down or up. And so when you're diversified, you remove the risk of losing a lot of your portfolio. Invest regularly is the second tip. So a good way to do that is to set something in your account so that every month when you get your paycheck, it pulls a certain amount, whether it's $50 to $1,000, however much you think you can allocate, and that number will grow substantially over time. Think about it as money that you might invest in a pair of pants that you may throw away in a year. If you invest that in stocks, you'll see great returns. I'll give you an example. I had a source of mine that I interviewed that years ago was advised to buy shares of a company that he spends money at. And so for him, one of his favorite things to drink was Coca-Cola. And so he would invest $5 to $10 a week in Coca-Cola stock instead of just buying Coca-Cola. And when we looked at his account years later, when I was interviewing him to see what his retirement fund looked like, he didn't even realize that that investment grew to $50,000 just from those shares alone. Now, I'm not telling you to go and buy Coca-Cola stock, but what I am saying is something as little as $5 to $10 could be a really surprising amount years down the line. Tip number 3 is one that a lot of people can overlook because it's often in a fine print of a fund that you're investing in, and that's the fees that come with these funds. And those fees can look really small at first, anything from 0.02% to 1%, but in the long run, that variation could have a huge difference in how much a fund can cost you. Let's say you have a fund that costs or has fees of almost 1%. Depending on how much you've invested and for how long, that cost could amount to 6 figures from your retirement account. You really need to pay attention to that. But at the end of the day, if you don't have an option to have access to a low fee fund, let's say because your 401k has limited options, it's still better to invest even if the fees are a little higher rather than not invest. Our next tip is consider short-term treasuries. When you buy a treasury or a bond, you're the one that's loaning the money to a government, for example, and you're getting paid the interest on that. For the longest time, treasuries had a very low interest rate, and so the yields weren't really high, and a lot of investors didn't really pay attention to them. But basically, right now, we have yields close to 5%. And so let's say you need your money soon and you don't want to buy, let's say, a bond that's 10 years long. You can invest in treasuries as short as a month to a year. Compounding essentially means is that you're not relying on your primary investment alone. As, let's say, your investment returns 7% a year, that 7%, you're not going to withdraw it. You're going to keep it in the account. And so that number gets bigger over time. A lot of people don't invest because they think that, well, they don't have enough money or make enough money to invest enough that there's going to be an impact on that money. But in reality, if you really look at the long-term outcome of investing, say, over 10 years, let's say you invested $1,000, and then from there, every month you invest another $100. Over a span of 10 years, that could amount to $23,000 just by looking at the historical performance of the S&P 500 alone. It's important to remember that all investing comes with risk, and past performance is no guarantee of future results. You want to avoid the concentrated risk that comes with investing in individual stocks. I know that can be an eye roller, but in reality, it's really risky when you're investing in single companies as a big chunk of your portfolio. Imagine a hedge fund manager or even a fund manager. They spend hours on end and they have a whole team that looks into individual stocks and their earnings releases, and even they don't get it right. So imagine the disadvantage that a retail investor could be at when the majority of their portfolio, or a big chunk of it, is concentrated in investing in individual stocks. It's just not the best way to go about it. It's really important that you think about investing towards a retirement fund at an early age. I know it's not something that maybe a Gen Z will think about, and maybe some millennials as well, but a lot of people think that Social Security is going to have their back when they retire, but if you really look at what you get per month from that, it's not enough. If you start today, it'll be easier because you can invest less and see more of a return, as opposed to if you wait until 30s or 40s, you're going to have to invest a lot more money to see the same amount later. And so that's really important to remember.
All the way down to the cutting board. All the way down to the cutting board until you can see it. Sounds good. Pour it in. Yeah, you can pour it right in that little hole. Oh, we did it wrong. Let's cut.
No!